Well, we've got so much event risk on the calendar, haven't we, Martin? We've got the June 23rd potential Brexit from the European Union. Obviously, we've got the forthcoming FOMC meeting. No one's expecting any rate hike from the FOMC this time around, following that very, very weak 38,000 increase in non-farm payroll. But the other issues, Martin, that are kind of occupying my mind at the moment are these bond yields and what they're saying about the global economy. Last night, the 10-year German government bond yield traded lower than 3 basis points. I think the actual low was 2.3 basis points. That is telling me that the bond markets are still seeing a lot of concerns down the road.
Okay, let's just talk about that. Let's talk about this a bit more, because it's not just German paper. 10-year Japanese paper, JGBs, although obviously the funding is very different. It's almost totally domestically funded. New record low on the 10-year Japanese paper there. And the U.S. 10-year, I think you're looking at about the second lowest level we've seen for this year, 2016, 168 or so. So, I mean, this is sort of it's a global phenomenon, John.
Absolutely. It's very much a global phenomenon. And as you say, the 10-year JGB this morning trading at all-time record lows. It's just really truly extraordinary. I mean, I started in the bond markets in the early 80s in London, Martin. I still cannot get my head around negative bond yields. The next dinner party or barbecue you go to, Martin, try and explain to your friends that are not in the financial world. In fact, try and explain it to friends even in the financial world what a negative bond yield actually represents. It is Alice in Wonderland stuff. It is just so bizarre, and I question the sustainability. I question the sustainability and the efficacy of monetary policy at this point in time. And I think there's a few alarm bells ringing around the world that there is almost an element of dysfunctionalism coming into capital markets. That is why, Martin, European bank shares and Japanese bank shares are being hammered so hard, because there is this concern about the dysfunctionalism.
Oh, indeed. I mean, negative interest rates seen as a tax on banks here. So what you're basically saying, John, is you're not just worried that negative interest rates aren't going to work. You're worried that negative interest rates could actually be counterproductive. Central banks could end up shooting themselves in the foot. I want to sort of take this out of isolation and as opposed to look at yields and levels of different tenures of paper, and take a look at yield curves in general. And I want to draw attention here. We just had an email in from a gentleman named Richard Lim, who watches our network and this show pretty regularly. He says, "Dear sir, the flattening yield curve tells us a recession is coming, and soon. In fact, the current low yield, negative yields in government bonds tells us not just a recession, but a Great Depression is coming. It's a certainty," he says, "given the huge mountains of debt, especially private sector debt that have built up over the decades. History tells us debt mountains always result in massive defaults, credit collapses, and hard times." Are you that bleak, John?
Wow, that's a great email, and I can't refute or reject the premise of his statement or question. The bottom line is we have too much debt. Also, his reference to yield curves is absolutely spot on. The last time we saw the US yield curve at these levels, that's 2s to 10s, was actually in 2006, 2007, as we were coming into the great crash of '08. Now, obviously, as everyone watching this show knows, the best predictor of a US recession is the yield curve. Whenever it has gone negative, we have always had a recession. So we're not yet negative in terms of the yield curve in the United States, but it is certainly flattening, which does talk to this issue of deceleration in the US economy. And obviously, negative 10-year yields in Japan, in Switzerland, and obviously all the way out to 7 years across much of Europe suggests the bond market is looking at weaker growth ahead. I can't really challenge the premise of his statement.